All right, so welcome to Chapter 2, where we will discuss long-term assets today. So long-term assets, we'll talk about buying and changes in value of the long-term assets. We'll recover the concept of depreciation and how to revise depreciation over time. Then we'll introduce a couple of new things likely to you, where we'll talk about natural resources, intangible assets, and goodwill, and then how to present and do some financial analysis on those assets. So a reminder that long-term assets are items that we own as part of our normal operations, but over the long term. Typically, long-term assets are something we buy that's necessary for operating in order, it could be a piece of machinery or a building that's required to do our business in. They're expected to be used on an ongoing basis. So we're not just going to use them up in, say, one fiscal year or one accounting period, that we're going to use it for a number of years likely. And it's also not intended to be sold. So if we're buying computers and selling computers to customer, it's considered inventory. But if we're buying computers for our staff to work and produce sales or do their work on an ongoing basis to support the organization, it would be considered a long-term asset. Now, when we buy a long-term asset, remember we have to consolidate the cost to get that asset ready to use. Couple of examples. If, say, we're building a building to provide our operations in, we might initially go and pay an architect or an engineer, probably have some insurance for the building process, as well as the building itself. All of those components would be considered part of the long-term capital cost. If it's machinery, say, for an example, you might have unrecoverable sales tax. So just a reminder, sometimes sales tax is recoverable. So any sales tax you won't get back. You might have installation costs by an outside organization, and freight costs by also a different carrier. And then you'll have the machinery purchase price. So the idea is all of these components would be part of your long-term asset for your machinery. So a little example here, we have the Sunshine Juice Company. They bought a new bottling machine in February, and we paid $120,000, or we're going to pay $120,000 for that machine. We paid another vendor $5,000 to ship it, and another one to install it in our organization for $2,000. So the total machine capital cost in this case, it would add the three components, being $127,000. So we had set up our long-term asset as a debit for $127,000, and we're assuming we haven't paid any of the three vendors at this point. So we would have a credit to our accounts payable of $127,000, again depicted on our balance sheet worksheet on the right-hand side. Sometimes we'll buy, say a piece of property, especially in real estate. You buy a piece of property, includes land, might have a parking lot, might have a building, might have different things included. And for amortization or depreciation purposes, as well, often for tax purposes, which you'll learn in the future courses likely, you need to split those components. So we have an example to walk you through where we paid a lump sum for a building, parking lot, and land for $800,000. In order to determine the proper allocation for those asset classes, is what we call them, we would get an appraisal on those three components. In this example, we said the land was worth $600,000, our building was $300,000, and our parking lot was $100,000. So it was worth $1 million, but we only paid $800,000. So what we would have to do is take that appraised value, determine the percentage allocation for each component, and apply that to how much we paid for the collective lump sum of assets. So in this way, we have our $800,000 allocated to those three different asset types that we purchased together. So our land would actually be worth on our books $480,000. So in this situation, our journal entry to record this transaction, we're assuming we paid cash at this point. So our credit to cash for $800,000 with debits to our three asset types based on the allocation provided using the appraisal allocation. $480,000 to land, $240,000 to building, and $80,000 to the parking lot. Now, sometimes over the life of long-term assets, you spend money to either maintain the asset or to maybe make it better. So often you'll have betterment, which is a common term used in accounting, or repairs. A betterment is where we typically improve the service potential of that asset. So therefore it should be capitalized. So either the life of that asset is now expanded, which is usually one of the best reasons. And we'll go through the questions to ask. A repair is where you had to do maintenance just to keep it working. It didn't improve the life of the asset, so that's considered an expense for the operations. And there are 4 questions you typically would ask yourself to determine whether it's an asset or an expense. So A, does it extend the life of the asset? If so, it's a betterment. B, or number 2, says, does the expenditure improve the productivity of the asset? And in that case, if it includes the productivity, the number of units it could possibly use, that would be considered a betterment. Does the expenditure reduce the company's operating costs? And is the expenditure a material amount? So you would have a capital policy for your organization that says maybe under $1,000, we just expense it. But if it's over $1,000, you go through this process to determine whether or not it's repair or capital. So then we move on to depreciation, which you would have covered in Accounting 1100 initially. And just as a reminder, for those that may have been a while, it's about allocating the cost of the asset over its useful life. And there are typically 3 different methods to record depreciation. There's what we call the straight line method. So we know it's say 6 years, 10 years, whatever that is, and it's the same amount every year. There's declining and double declining balance, which are percentage based. And then there's the units of production method based on the total units expected to be produced by that piece of equipment. A second component of depreciation is to understand if there is a residual value. Residual value is where we think after the end of the time that we plan to use that asset, is it going to be worth something? Very often organizations assume 0, that it'll just be scrap. But many times as well, especially in the production environment, you might have a widget machine that says you're going to produce the first 2 million widgets, but at the end, it's still going to be worth something to somebody else that maybe doesn't produce this high quality equipment. And maybe it's going to be worth, $5,000 at the end, and you paid $500,000 up front. So that's what we call the residual value. And this is important because for depreciation purposes, we always start with the initial cost. We subtract the residual value, and that determines what our depreciable cost is. That depreciable cost then is amortized or depreciated over the years of that asset based on one of those 3 methods we just spoke about. Some will get into the different methods. First method then is the straight line method. In straight line method, it's the same amount of depreciation per year. So a simple example is we bought a machine for $5,000. The machine is expected to have a useful life of 5 years, but there's a residual value of $1,000. So we would take the asset cost less the residual value divided by the number of years. So in this case, for this machine, we would depreciate $800 a year. And we'll just, actually, there's a mistake in these default slides. I did not create the slides, I'm just using them, and I see that this should be January 1st, 2018. So you have a full amortization in the first year of $800. And you'll see as we fill in the chart, recall from previous class, is that the depreciation expense does not carry forward. The accumulated is the sum of all years to date. Net book value is the difference of the cost less accumulated. So you'll see after the 5-year period, our asset would be worth $1,000 net book based on the residual value that we used. Okay. Each year, we would have a journal entry to debit depreciation expense for that machinery for $800 and credit accumulation for $800 as well for that machine. Now, let's assume that the asset has no residual value. This means that the total amount to depreciate is the full $5,000. In this case, our depreciation per year would be $1,000. So if we roll this forward to the end of year 5, we'll show that there's a net book value of 0 at the end. In this case, our annual journal entry would be a debit to depreciation expense for 1,000, and a credit to accumulated for 1,000. At the end of 5 years, we will have a zero balance. Okay. So this is just a little worksheet showing that net book value after 1 year would have $4,000, just to show you what that would look like. So a reminder, accumulated depreciation is what we call a contra account to the capital asset accounts. All right, so next we'll jump over to the declining and double declining balance. So let's, in an example, we'll consider the purchase of equipment worth $10,000 has a useful life of 5 years with no residual value. So in this formula for the double declining rate is what we'll use in this example, is 100% divided by the useful life in years times 2. So if we take 100% divided by 5, 20% per year, but we're doing a double declining balance, so we'll use a 40% declining rate. So we'll start with the $10,000. 40% of that is their depreciation expense in the first year. So our net book value after the first year is only $6,000. If you remember, in the declining and double declining balance, you use the net book value closing from the prior year to determine your depreciation for the next year. So we take our 6,000 opening net book, 40% is 2,400. Our accumulated depreciation then is 6,400, showing a net book value of $3,600. We roll this forward, continue the same calculations. You'll see that our depreciation expense each year drops dramatically. And in theory, our net book value will never get to zero because it's a percentage of our net book value. But in this case, after 5 years, using the double declining rate with the useful life of 5 years, we would have a net book value of $777 and actually 60 cents here. Okay. And there was no residual value used as part of the original formula. All right, so what if there was a $1,000 residual value? What we would do is we have the same calculations for the first part of the table. That means you can't dip below the 1,000. So for the final year, since we're in our final year of life, we're at a net book value opening of $1,296, but we can't go below $1,000 because that's what we agreed was a residual value. Our depreciation expense in the final year wouldn't be 40% at $1,296 because that would drop our net book value below 1,000, and therefore would only be $296, resulting in an accumulated of 9,000. Okay, so that's where residual comes into play for double declining balance as an example. It's the same for declining balance. All right, next process is the units of production method. So in this case, we always need to choose an appropriate unit. So if it's for a vehicle, perhaps it's kilometers driven. If it's a machine, maybe it's hours operated, or it's the output, how many widgets it's producing. Second step is we need to estimate the number of units to be used for the life of the asset. So say a car we think is going to die after 100,000 kilometers, I hope not. And a machine might only produce 10,000 hours of production. Step 3 is we need to calculate the per unit cost. So it's the total cost of the truck or the machine, less the residual value, divided by the total units of production. So in this example, we'll say it's a $50,000 truck, only going to drive 100,000 kilometers, which means for every kilometer driven for this company, 50 cents per kilometer would be depreciated. And actually, that's exactly, sorry. And then you would calculate depreciation for the year. So you would take the 50 cents per kilometer. Say we drove 10,000 kilometers the first year on the truck. You would take the 50 cents times 10,000. You would have a $5,000 depreciation for year 1 for that truck. Okay, so multi-steps in the units of production. So let's do a little example here where this company bought a truck for 110,000. We think it'll be worth 10,000 at the end. We want them all trucks to be in top condition, so we only drive them for 200,000 kilometers. Okay. So now we want to calculate the depreciation based on these consumptions. So first of all, we need to do the per unit. So we paid 110,000, $10,000 residual, take the difference being 100, divided by the 200,000 kilometers expected. It means it's 50 cents per unit or 50 cents per kilometer in depreciation. So for the first year, if we drove 30,000, we would take 30,000 times 50 cents, $15,000 of depreciation. Second year, 25,000 times 50 cents for 12,500 in depreciation. Third year, 35,000, 50 cents per is $17,500 in depreciation. So at this point, we have $45,000 in depreciation after 3 years against a $110,000 purchased vehicle. Now, in depreciation, often you wouldn't always purchase assets at the beginning of the fiscal year. Okay, so we very often have partial years, and often we don't always sell it at the end of the year. So we need to have a policy for when we account for depreciation that considers your purchase or sell date. There are different options. Very often use the half-year rule. So the first year that you own that asset, you just take half of it. Just to say it's an average, you might have bought in any one of the 12 months. The other option is you might have the nearest month. So if you bought it in the first half of the month, you include that month. And then you take, say you bought it in March and your fiscal year is December, and you bought it March 15th or March 1st, you would take 10 months out of 12 times the first year depreciation. In the nearest month, if 16th to 30th is not included, so say you bought it March 16th or March 30th, you would only include 9 months out of 12 because you would not include the month of January, February, or March. And then sometimes organizations say no depreciation in the year of acquisition. And we use a full year of depreciation in the year when it's sold. So the idea is to defer your depreciation expense to the end. Not really the best for tax purposes. You're always better off to reduce tax up front, but depending on your business, this might be beneficial. Now, under accounting rules, you can't change it all the time. You have to have one policy and you stay consistent. Okay, so those are a few different examples of policies for partial years. Okay, we'll do a little example here. We purchased a $120,000 packaging machine on March 27th, and the company determines that the packager will have a useful life of 10 years. Sorry, I got a cough for a second, so I need to mute. After those 10 years, did I unmute? Yes. After those 10 years, it will not be salvageable. Therefore, there's no residual value. The machine will be depreciated by $12,000 a year. Okay, so it's 120,000 divided by 10, $12,000 annually. And the company has a December 31st year end, and we use the nearest month rule. Okay. So in this case, we assume no depreciation in the month of purchase because it was the latter half of March. And then we assume monthly depreciation thereafter, including the month of sale. So in this situation, in the first year being 2012, we would depreciate $9,000. It'd be 9 months. So we would take the $12,000 divided by a year times 9 months, 9 months being April to December. So in the first fiscal year of 2012, there'd only be $9,000. For the second through the, 10th year, it would be $12,000 per year because we would have a full 12 months. And the 11th year that we own it, because it's a partial year, we would have January, February, and March. Okay, so we would have 3 months. Otherwise, $3,000 in depreciation in the final year that we own that asset. All right, another actually a little summary table. This is the annual depreciation based on what we just spoke about. So year 2012, 9,000 for 9 months, 12 months for a number of years, 3 months at the end. So total depreciation, just to prove our math, would be 120,000 over those 10 years of useful life. All right, we'll move on to disposal of assets. So very often we dispose them in one of 3 different ways. Either we retire the asset, we sell the asset, or maybe we change it in on a trade-in for something new. Whenever we dispose of, there's typically a gain or loss generated from the disposal of that asset. So what's the value on our books does very seldom match exactly what it's worth at the end of its life, but it's usually close, you hope. So let's assume an example where a company has equipment that costs $5,000, had a useful life of 5 years, residual value of $1,000, and we need to record the journal entry for the sale of the equipment if the asset was sold after 5 years. We'll have 3 different scenarios. The first scenario, what if we sold it for $1,000? We would record the cash for $1,000, and the $1,000 matched our residual value or our net book value that's on our books. So it'd be as simple as removing the accumulated depreciation by debiting it by $4,000 and removing the equipment as a credit for $5,000. No gain or loss. If we sold it for $500, we would have a loss. On our books, it says it has a net book value of $1,000. We still get rid of the equipment of $5,000, still clear out the accumulated depreciation of $400, record the cash received, debit for $500, but we have a loss, so we need to record the loss on disposal of asset in order to balance this transaction. Any loss on disposal of asset will hit our income statement, typically under other income or expenses at the bottom. The third example is what if we sold it for more? In this case, we record the cash, remove the accumulated depreciation, credit the equipment, and then we have a gain or a revenue, a credit on disposal of that asset for the $500. All right, here's another example where what if a company decides to donate it to charity? In this case, we would have an expense account set up as a donation expense for the value of the asset. So in this case, we would still get rid of the equipment asset, so credit for $5,000, still get rid of the accumulated depreciation on our books for $4,000, and then we would debit a donation expense for $1,000 to record and balance the transaction. So just a little summary worksheet on the right-hand side. It would show that the net book value was originally $1,000. So that would be removed through this transaction. And you'll see a donation expense would be created through that transaction of $1,000. All right. Often, through useful life of an asset, our assumptions change. So let's just go through an example. In this situation, we bought a molding machine at a cost of $300,000. We thought it would last 10 years with a salvage value of $20,000. So our original thought would be that we have 300 plus 20 is $280,000, and just say a straight line over 10 years. So we would amortize $28,000 a year. However, let's assume that after 5 years, so we're halfway through the original useful life, we decided that it could be extended by 5 more years to 15 instead of 10. And our salvage value would actually be higher than originally thought at $40,000. So in this case, the original useful life was 10 years at a $300,000 cost, but it was extended by 5 years with a $40,000 new residual value. During the first 5 years, I made reference that the annual amortization or depreciation would be $28,300 less 20 divided by 10, $28,000 a year times 5 years. You would have already depreciated $140,000. That tells me that our net book value at the end of the 5 years would be the purchase of $300 less the $140 is $160,000 net book value at the end of 5 years. Now our assumptions changed. So our $160,000 net book value, we have a residual value of 40 now. So we have $120,000 to amortize over the next 10 years. 5 years has passed. We think 15 in total. So we would take the remaining balance and just straight line it over the next number of years. You don't go back and readjust. We have the calculations here that I just spoke about. Oops, I'll go back just to keep it there for a second. Okay, so the net book value after 5 years, 160. Take the 160 less the new salvage value over 10 years is $12,000 a year for the rest of the 10 years. All right, an impairment sometimes is when the fair value of your asset drops below your net book value. it could be change in technology, it could be change in market price, it could be damage to the asset. Maybe I hate to say it, knock on wood, a fire, maybe it destroyed the asset, things like that. When there's an indicator that's impaired, you must conduct tests to determine whether the asset's fair value is actually lower than the net book value. A little formula here that says impairment loss is incurred when your net book value less your fair value is a negative number. So we'll do a little example here. We assume that on December 31st, the company realized the value of its machinery has been impaired due to physical damage. The fair value is determined to be $60,000, and the original cost though was $130,000. And up to this date, we've recorded depreciation of $40,000. So our net book value is the cost of $130,000 plus the depreciation of $40,000. So our net book value is $90,000. Our impairment loss at this point in time is $90,000 net book value less the $60,000 fair value, which means we have an impairment loss of $30,000. To make this right on our books, we would have to debit impairment loss, which hits our income statement of $30,000, and credit the accumulated depreciation. So therefore, we're adjusting our net book value by doing an adjustment to an impairment loss expense account. You don't just increase depreciation expense when you have an impairment due to market conditions. Okay. All right, we'll move on to natural resources. So obviously, there are many organizations that have forests or mines, et cetera. And in this case, instead of using the word depreciation, they typically replace it with the word depletion. Okay, so they're slowly using up that mine, they're slowly removing the forest and selling the lumber or whatever that might be. And in this case, we always use the units of production. So we know how many trees, how many acreage, we know how many tons of ore or silver or diamonds are in that mine, or at least it's a good estimate. So we use the units of production. So say in this example, the company has bought land containing an estimated 8 million tons of ore at a cost of 10 million. The assumption here is there is no residual value because the assumption is we will mine all of the ore. So in this case, we're assuming the full 10 million less the residual value of 0 divided by the 8 million tons estimated to be in the land would be $1.25 per ton. So say for an example, we mined 2 million tons of ore in the first year. Our depletion expense for that mineral deposit would be the 2 million tons times the $1.25 to give us 2.5 million. And just like depreciation, we would have a similar journal entry, a debit to depletion expense for 2.5 million and a credit to accumulated depletion for 2.5 million. Another category of assets are intangible. Like we really can't put our fingers on it. It's nothing that you can touch or feel or that. And on Goodwill. So a couple of examples are, you might have a patent or a copyright on something that nobody can copy, so it's worth value, and you should amortize it over the life of that patent. So patents are typically issued for a number of years, and so you would use those number of years as its useful life. Things like Goodwill, so you purchased the company and you paid more than what it was worth, that's considered Goodwill, and we'll go through an example in a second. In that case, there's typically no amortization because the idea is it should always maintain that value. It doesn't always happen. So in this case, on the patent, for example, if we bought a patent from another company and we paid $28,000, we would debit our patent for $28,000 and credit our cash because we paid them cash. If we're expected that patent would allow us to bring additional revenues for 7 years, we would use 7 years straight lined for that patent amortization. So we'd have an amortization expense for patents, debit for $4,000 for the first year, and a credit to the accumulated for that first $4,000. And that would continue for the full 7 years. Now, Goodwill, as I previously mentioned, is when you bought another company, but we paid more than the value of the net assets. And that's very common that there's There's value in the people, value in the processes, or value in the client base that that organization has. So often companies are purchased at prices that exceed their net assets. So in this example, we have Vicky's Enterprise decided to buy Jack's Sweets on June 1st, purchase price of $1 million, and their assets of 1.5 and liabilities of 700. So in this situation, we would have to record the assets that we just purchased from Jack's Sweet at 1.5 million. We would record our liabilities because we're assuming the liabilities, what's owed to various vendors of 700. We would record the credit to cash that we paid them $1 million. And again, to balance this transaction, we paid them $200,000 in quote unquote goodwill, which exceeded the value of the net assets. So we would have a debit to goodwill for $200,000. And that goodwill would not be amortized. Now, however, over time, if you revalue what you bought, the assets and liabilities from Jackson, maybe after a while you determine that the value of the goodwill is reduced. So maybe there's not as much additional value as there originally was. So it's been reduced. And in this example, we've estimated that the impairment or reduction in goodwill was $50,000. So we'd have a debit on loss on impairment of goodwill. Again, this is an expense account. And we would credit our goodwill for $50,000. So now our goodwill on our balance sheet, instead of being 200, would be 150,000. This does happen from time to time. All right, moving into the last few slides, we'll talk about presentation of financial analysis. So when we're talking about assets, one of the common formulas that we use are asset turnover ratio. And another one would be return on assets. Asset turnover measures how quickly a company converts its total assets into revenue. The formula for average total assets, just as a reminder, is the average, so the beginning plus the end of the year total assets divided by 2. So that's your average total assets. The asset turnover takes the revenue earned in that year divided by the average total assets. Okay. The return on assets looks at the net income, so your bottom line net income after all operating expenses divided by average total assets. Okay. So we'll go through a couple of examples here. So we have these two companies on screen. We've got the Lynn Company and the Walk Company. The Lynn Company, we're given, actually for both companies, we're given June over June each year. And for example, Lynn has net sales of $3.5 million currently, compared to 3 the prior year. Net sales for Walk has $4.5 million current versus 4.1 the previous year. So a quick glance, you think, oh, Walk had more sales. Okay, and they had more net income. Okay, but let's go and look at the return on assets, for example. So return on assets for Lynn, we would take the $590,000 net income, okay, divided by the total assets average, which would equal 35% in this case. So the average total assets would be the 1.15 million plus the 2.2 million divided by 2. Our return on assets for Lynn are 35%. However, on Walk, since our total assets are so much larger at 4.8 and 5.5 million in the last 2 years, our return on assets is only 16%. Actually, our ROA is a heck of a lot better for Lynn. Okay. Moving on, we have a different example here, Joe's Corporation. We were given some information. We're asked to look at the asset turnover. So we said that was revenue divided by total average assets. So we had $180,000 in sales divided by average total assets of 120 is 1.5 times. Okay. So that means the assets value, they only 1.5 times the value in revenue in the year, which in my opinion isn't great. I would always assume that you would have, 4 to 12 times as an asset turnover, which in what I've seen would be an acceptable rate. All right, so that ends chapter 2. Hold on, I'm going to stop share. Yeah, hopefully you find this helpful, and we'll talk to you later.